Today, I am specifically making this video on April 15th, tax day, to talk to you a little bit about your home equity, how to make that work for you, and how to avoid capital gains taxes. Now, you could be thinking, hey, I don't have to pay any capital gains taxes on when I sell my home because this is my primary residence. And yes, many of you are correct, but remember there are exclusions. So if you have equity in your home over $250,000 as a single person or over $500,000 as a married person, and I guarantee there are many of you that are watching this video that do have that much equity, then you will have to pay capital gains tax when you go to sell. So I do want to talk to you about that in a little bit more detail, but also let's talk about how to make that current equity in your home work best for you. Does it make sense to take out an equity line? Well, equity lines aren't cheap these days. HELOCs are hanging around 7%. A HELOC is just a home equity line of credit. That's what HELOC stands for. So they're the same thing. Whether I say line of credit, HELOC, that just means taking a loan out on the equity in your home. You can also take a loan out on investments. I will point out that if you are making upgrades to your home, whether it's a loan on your investments or a HELOC, that interest is deductible if you are taking that out of your primary residence and making the improvements on that primary residence. So that may make sense if you are planning to do updates on your current home. Second area that I wanted to touch base on, how do we get around this 500,000, 250,000 single, 500,000 married, that you may have to pay capital gains over and above that when you go to sell? Well, one piece of the puzzle is to save receipts for any improvements that you have done. So this capital gains is basically between what you purchased the home, not what your loan amount was, but what you purchased your home for and what you're selling for. So say you purchased for $400,000 and you're selling for $900,000. That gives you $500,000 of equity. What you subtract out of that is any closing costs. And when you're selling, commission, say you're selling $1 million home, commissions could be around $50,000. So you can deduct commission out of that, and you can deduct any improvements you have done in your home. So I know personally, I've been going back, finding receipts, keeping track of any improvements we put into our home, should we ever get to that point where we have that much equity. What do you do if you are sitting in a home right now and you have over that amount of equity and you don't really want to pay capital gains tax? Well, maybe you're in a situation where you can actually move. So you have made quite a bit of equity now, sell your house, whatever equity you have, and to limit that capital gains, start now gaining equity in another home, especially if you're over that $250,000 single or $500,000 married. One other point I want to make is if there's a divorce situation, you would have to talk to your accountant, because I've read different blurbs online. I've talked to my accountant whenever it comes to a divorce, whether or not, if that spouse has lived in the home for 2 years, if you could consider that and use the $500,000 rule versus the $250,000 rule. Most of what I read said, regardless, if you sell your house and you are now single, you are held to the $250,000 rule. And if you have purchased your home back in 2019, it is not hard to have $250,000 of equity in your home right now. So something to consider. I know moving's not for everyone, just to avoid taxes, but it may be something that you want to consider moving forward with this excess equity in your home, which is obviously a good thing. We just don't want to have to pay taxes on it if we can avoid it. So I will be back in May, and I hope this was helpful.